Right, in this video, we will be covering impulsive waves, the characteristics of impulsive waves, and how we can begin to identify impulsive waves on a price chart. So this video is going to build on the last one. The last one was really foundational, very basic, but I still tried to pack as much valuable information in there so that you have an idea of where we're going now in this next video. So before we look at an actual price chart, real historical data for the US dollar index, we're going to look at idealized line diagrams once again. So I'm going to draw here an idealized uptrend. And we can obviously just flip this to make it relevant for a downtrend as well, because you will see impulse waves to the upside and to the downside. Impulse waves are required in order for a trend to survive, in order for it to continue going in any one particular direction. And you will notice in every single financial market that trends are made up of pivot points. Pivot points are where one wave ends and another wave begins. So by definition, to have a trend, we need a series of pivot points moving together in one direction or the other. In an uptrend, we need to see higher highs and higher lows. If we don't have higher highs, it is impossible to have a sustained uptrend. It's impossible. If we can't clear this prior high here with this wave, then we cannot have an uptrend. All right, we need to see this stair-stepping market progression in order for a trend to continue surviving. And then, like I said, you just simply mirror this, flip it in order to make it relevant for downtrends. So in a downtrend, we need to see a series of lower lows and lower highs. So whether it's an uptrend or a downtrend, you will notice that the pivot points, they're moving in concert together in one particular direction. Impulse waves are simply those waves that establish with trend pivot points. All right, so the lower lows, and notice how the corrective waves are making the lower highs. All right, so the corrective wave will always retrace a percentage of the prior impulsive wave before the correction ends, and we make way for the new impulsive wave. All right, so impulsive waves are the waves that define the trend and keep it going, whether it's higher or lower. Right? When you see something like this, a series of sideways waves, some of these waves can be impulsive in nature, but the overall trend, when you kind of aggregate or combine all this price action together, the overall trend is sideways, which means that overall there is no impulsive price action occurring here over all of these different waves. But waves, individual waves themselves can take on impulsive characteristics. So for example, this wave right here could be an example of one impulsive wave within a series of larger corrective waves. When a market is trading like this and the price action looks like this, it is very difficult to trade. Very difficult to trade. In my opinion, the job of a trader is to make money. All right. If you want to analyze this, if you want to come up with accurate forecasts, then be my guest. That's what an analyst does. But a trader has to make money from the markets. All right. So that's a huge fundamental difference between being a trader or being an analyst. As a trader, I am not getting involved in a market like this. There are simply better opportunities elsewhere. I mean, there's a lot of currencies out there. There's a lot of commodities, a lot of crypto coins, a lot of stocks, a lot of ETFs, a lot of everything, right? And that's why being a multi-asset class trader is ultimately where you want to end up. So that if, for example, Forex is going sideways in basically every currency pair, then you can abandon Forex for the time being and look to a better market, all right? Now, I don't want to get too off track, so we're going to go back to impulse waves. So because impulse waves are those waves that propel the market to new highs or new lows, well, they're pretty special, aren't they? So these impulse waves will have certain characteristics. If we're talking candlestick charts, then impulsive waves will usually be made up primarily of one color of candle. So in an uptrend, in my charts are black and white candlesticks, right? So in my case, we'd be looking at a lot of white colored candles in an uptrend. In an impulsive in an impulse wave, that's part of a greater uptrend. All right, we'll take a look at an example right now. Move this to a weekly time frame. So we can see here, just visually looking at this wave here, we can see that there are very few black colored candlesticks, very few bearish candlesticks in this run. This is an impulsive run, right? It's obvious once you start thinking about what an impulse wave is, why it would be made up of mostly one type of candle. All right. Now there will be impulse waves that have a bigger mix. I would say this is fairly textbook, almost perfect as far as the colors of a candle that you would want to see. But the point is that if a market is trending strongly, it should be running over. It should be running over bears in the case of an uptrend. If bulls are firmly in control of a market, when a market is ready to impulse, it will do so convincingly. All right. You will see corrections. Here's a correction, here's a correction, here's a correction. But the corrections will be small, relatively speaking. They won't take up too much time, and the ensuing breakouts will simply be very convincing in terms of what that price action looks like. All right. Now, this is when momentum is at its strongest. All right. And if I'm going to pull up some secondary indicators here, just so you can take a look, I want you to pay attention to RSI. You can see how in this strong impulsive wave, RSI really peaked. RSI became quite overbought, as they like. I hate that term because overbought doesn't mean that something's over, right? It's a momentum. RSI is a momentum indicator. And in a future video, I will cover RSI in far greater detail so you know how to actually use this indicator to its full potential. But right now, I just want you to pay attention to how this wave made a high here and how the next impulse wave broke out and made a new high above it here. But look at RSI. We have what's called bearish divergence. RSI peaked here. Even though prices did not peak here, they peaked here before we went on to make a double top several months later. But what I want you to pay attention to, okay, is how RSI peaked here, prices peaked here, and that is why we have this bearish divergence. When we see bearish divergence like this, it means that the trend is losing momentum. It doesn't mean that the trend is over. It's just a warning that we are losing momentum, right? And when you see momentum starting to decline, we can make some assumptions about what that next impulse wave is going to look like. It's going to be less strong. It's going to be visibly weaker. This is where candlestick analysis is in fact a very valuable skill to have. You can see here, we have a lot more bearish candlesticks in this run. Here, you can see how the corrections are smaller when momentum is at its strongest, right? We can see that momentum has peaked here, right? In this particular case, however, we can see that the corrections are longer in both time, right? So they visibly just last longer. Each candle here is a week. And they also go deeper. See how this correction is quite deep. If I just look as a percentage, how much this correction has retraced over this wave here, we're looking at over a 61.8% correction, all right? Compared to here, it's not even a 38.2% retracement, okay? So the percentage of the retracement is significant. It's giving us a lot of information. Also notice how we're seeing a lot more overlaps between waves. We're seeing overlaps here. So we're grinding higher. We're not exploding higher, okay? So not every impulse wave is created equal, but the one characteristic that really defines impulse waves is their ability to break new ground. So here we can see we have made a new high. We've made a new high above here, and this wave is in fact an impulsive wave as a result. We can classify it as an impulse wave. But like I said, momentum is fading. So we have to use that information wisely. If we're trading this impulsive move, we have to know that we can't overstay our welcome, because that impulse wave here is not going to be as strong as the impulse wave we had over there. All right, now we're going to look at some bearish impulse waves. So we'll start off here. We have a bullish impulse bounded by these two red arrows here. And then we get a correction. Prices go sideways. We don't really get much in the way of new highs or new lows. This is really kind of a sideways trend. And then what happens? We make a new low. Sorry, I'm just going to redo these arrows here for you guys. We make a new low here. We break below the lowest point of this current wave. So this to me is now an impulsive wave. It's a bearish impulsive wave, which may, and you'll see why I say may in a second, because I'm just going to bring time back. If we pretend that we're trading right now in June of 2020, we could say, yes, this is a bearish impulsive wave, but so far we're still correcting this larger bullish impulse. This larger bullish impulse here. And this comes back to the fractal nature of the market. And this is where a lot of traders start getting confused, okay? So what we can see here is a bullish impulse followed by a corrective movement, all right? And I do remember trading this in real time, all right? And so I didn't trade the US dollar index. I traded the euro, which is basically a mirror image of the US dollar index. But my point being, I traded this decline in the dollar in real time, and I got out fairly quickly. I didn't capture this entire move. Why did I get out quickly? It's because this bullish impulse looked very convincing. So I thought that the correction, even though this was impulsing in a bearish fashion, we were still correcting this overall bullish wave, and therefore the next big move would be to the upside. So I probably got out, somewhere around here, got in somewhere around here. It wasn't a huge trade, but it's not the outcome of the trade that I want to talk about. It's why I got out so early. It's because I believe we were correcting this bullish impulse. Of course, what ended up happening? Well, we eventually broke new ground. Once we took out this low here, on this at the end of this weekly candle right here, when we closed below this low, that to me is confirmation that we have a significant change in trend. All right, a significant change in trend. So we had a bearish impulse, we had a little correction here, then we had another bearish impulse. And this one is a big deal because we've taken out this entire bullish impulse wave. That tells me that there is no way until we start making higher highs and higher lows once again that the US dollar is in a bull market. Right? That doesn't mean there won't be buying opportunities on the dollar. But what it does mean is that the trend is pointed lower. The better opportunities will be to the downside. Okay? The better opportunities will be to the downside. And once more, let's take a look at the characteristics of impulsive price action. Here in this bullish impulse, we see mostly bullish candles, little corrections. In the bearish impulse, we see mostly bearish candles, very little bullish corrections, right? This is the most significant bullish correction. And then again, as we start impulsing here, we see momentum pick up, bearish momentum pick up, and we see mostly bearish candles. And that pattern is going to continue until the trend starts to lose momentum. You can see here, this is the largest correction that we've seen thus far. And let's see if we have any bullish divergences now in our RSI indicator. So this is that low, and what we would be looking for is a pickup in momentum. My goodness, look at that. So we have that bullish divergence. We can see how RSI went from being quote unquote oversold to being slightly less oversold to now getting back into a neutral momentum range. So that tells me that this trend is currently losing momentum. It doesn't mean it's over. It doesn't mean that the dollar index is going to go back to 100 tomorrow, all right? What it does mean is that this current trend is losing momentum. So as a trader, this tells me not to overstay my welcome if I'm short the US dollar. All right, and we can see how the price action has developed since. Now, we've had a more significant bullish correction, and we couldn't make a new low. Remember the definition of a trend. We need pivot points to move in concert. So if this was our prior low, we haven't been able to break below that. On the other hand, we haven't been able to break above this high either. So right now, on the weekly time frame, the dollar is kind of in no man's land. It's kind of in no man's land where we haven't made a new high, so we haven't confirmed a bullish impulse, and we haven't broken below this low, confirming a bearish impulse. But either way, just the very fact that prices are starting to trade sideways and that we have significant bullish momentum tells me that this downtrend is beginning to weaken, right? So I hope this video was helpful in covering the characteristics and the definitions of impulsive waves. Impulsive waves must make new highs or new lows. They're going to look strong in terms of their internal momentum signatures. And I'm not talking about the RSI indicator here. I'm talking about the candles, all right? Notice how they're mostly one color. They're bigger bodied. Notice how in this corrective wave here, the candles are kind of jumbled and you get a lot of small bodied candles here, indicating a visible lack of bullish momentum. And what happens as bearish momentum picks up, we get larger unicolor candles, okay? All right, so I'll see you guys in the next video where we will be covering characteristics of corrective waves.